Hi, I'm Reena Agrawal, research economist at Veros Real Estate Solutions. Welcome to this latest episode of the RiskWire Webcast.
My name is Eric Fox, and I'm chief economist at Veros Real Estate Solutions.
Today we are going to talk a little bit about the latest employment report and what that means for the housing market. So the unemployment rate for April came in at 3.9%, and the report was a little softer than what many had expected. What are your views about that, Eric?
Well, I think we definitely saw the new jobs number at 175,000, lower than the 240,000 that we were expecting. But I think when we look at the unemployment rates, we've been very stable from 3.9% in February to 3.8% in March, now back to 3.9% in April. So I don't think we're really significantly more unemployment or less unemployment. In fact, the new jobs are the same as they were in 2017 through 2019 on average. So the unemployment picture, I feel, isn't really drastically changing. We see this all the time with new numbers, that they are a little higher, a little lower. We're looking for the big trends here, and we're just really not seeing huge changes in unemployment rate. Maybe some very slight softening, but I think more flatness is really kind of the characteristic. Inflation, I think, perhaps is the bigger story. We were 3.2% in February, and we're 3.5% in March, and that's really slammed on the brakes for the Fed to do much of anything in terms of rate cuts. So if we look at the housing market, I think seeing mortgage interest rates where they currently are at around 7%, that's probably not going to change too much. We've seen earlier in the year, folks were saying that we would have 3 rate cuts, and the first one being May. Now we're certainly not going to have one in May, and folks are indicating perhaps just 1 or 2 between now and the end of the year. Quite frankly, I'm not sure we'll even have one. And so our official Veros interest rate for mortgage interest rates between now and the end of the year is to drop only to 6.9%, and that's from the low 7% range that we are currently at.
So that means that folks that were expecting that housing is going to get more affordable, rates are going to go down so much that would make housing payments a little less. So in your opinion, we're not going to see any of that?
No. I really think there's for too long been a narrative in this country that we're going to get back to where we were in terms of sub 5% interest rates. We're going to somehow get lots of supply on the market. Everybody can buy their houses at sub 5% interest rates. And to be quite honest with you, low 7s is historically a very low interest rate. And so we should embrace the rates as they are, and not be constantly thinking that we're going to be sub 5%. That was a very unusual interest rate environment in history. Housing is based on supply and demand. We don't tend to see huge drops in house prices over time. We never have. For small periods of time, yes. But over the long haul, housing is a very solid investment. It's a scarce resource. There's limited supply. And so that operates on the laws of economics with supply and demand. And so I'm afraid that it will not get cheaper. It will remain a solid investment for anybody, but it's always going to be a struggle in many parts of the country to get into that first house.
Thank you for your insights, Eric. That was a good discussion on where we think the housing market is going to be in this year and towards the end of the year.
Well, thank you very much, Reena.
Thanks for joining us. See you next time.